Mark thought he had it figured out, right up until the Tuesday his net worth crossed $2 million. He was 51 years old, an operations director earning $140,000 a year. He'd saved for 26 years, invested through 3 crashes, and never once touched the principal. That Tuesday morning, his brokerage op showed $2 million. 18 months later, 740,000 of it was gone. Not in a market crash, not in a scam, in 5 quiet decisions that felt completely reasonable. Because here's what nobody tells you about hitting $2 million. The rules change the moment you arrive. The strategies that built your first $2 million are not the strategies that keep it. Roughly 1.5% of Americans ever cross a $2 million net worth, and a shocking number of them slide right back under that line within 10 years. This is the story of how Mark almost joined them and the math behind every single step. Run the numbers with me because the same 5 traps are waiting patiently for you. Let's be clear about what $2 million actually is, because most people picture it completely wrong. It is not yachts, private jets, or quitting work to sip cocktails on a beach. At a safe withdrawal rate, $2 million produces about $80,000 a year. $80,000 a year is real freedom, but it's a salary, not an empire. That's a comfortable upper-middle-class income forever, if and only if you never break the machine. And the machine is shockingly easy to break in your first 5 years above the line. One study of 3,200 wealthy families found 70% lose their wealth by Generation 2. 90% lose it by Generation 3. These were not careless families. They were families who treated arrival as the finish line. Mark made that exact mistake, and so did almost everyone who congratulated him. Carla crossed $2 million 2 years earlier, and her story went very differently. Same office, same salary band, and almost identical portfolios on the day each crossed the line. 5 years on, Carla was up $400,000, while Mark was down $740,000. Same market, same years. The difference was 5 decisions, and none of them involved picking stocks. Mark was 51, an operations director, married, 2 kids, a mortgage with 11 years left on it. He started investing at 25 with $50 a paycheck and never missed a month. 2008 cut his portfolio nearly in half. He kept buying anyway. March 2020 did it again. He kept buying anyway, hands shaking slightly. 26 years of that discipline is what $2 million actually looks like. His $2 million sat in 3 buckets: retirement accounts, a taxable brokerage, and home equity. $900,000 in retirement funds, $700,000 in brokerage, $400,000 in the house. Carla was 52. Same company, 1 floor up, earning $135,000 a year. Divorced at 40, she rebuilt from almost nothing in 12 years of relentless index investing. Her split on crossing day looked nearly identical: index funds, retirement accounts, and a paid-down townhouse. The first difference appeared within 30 days. Carla spent $383 on something Mark had never even heard of. Mark spent $62,000 on something every neighbor could see from the street: a brand new luxury SUV, paid in full, because after 26 years, he'd earned it. That was decision number 1. Decision 2 arrived at a backyard barbecue. A friend leaned in and said a private crypto fund was returning 60% a year, 3 years running. Friends and family only, minimum buy-in $50,000. Mark transferred $150,000 that weekend. It felt small next to $2 million. Decision 3 found Mark 2 months later. A wealth advisor offered to manage everything for just 1% a year. Nothing up front. 1% sounded like a rounding error. Mark signed the paperwork in under 40 minutes. Decision 4 was his father's voice on a Sunday phone call. "You've won. Stop playing." Terrified of another crash, Mark moved $800,000 out of stocks and into cash all at once. Decision 5 was the quietest. He told his wife the number and absolutely nobody else. Not his kids, not a lawyer, no will update, no plan, no instructions anywhere. 5 decisions. Each one felt responsible, even smart, in the exact moment he made it. Now, watch Carla face the same temptations. She test drove the SUV, loved it, and kept her 9-year-old Honda. The same friend pitched her the same crypto fund. She asked one question: who audits it? The silence that followed was her answer. An advisor pitched her too. She paid a flat fee planner $2,500 once. Her index funds stayed exactly where they were, untouched. And her $383 bought a $1 million umbrella insurance policy. She also wrote a one-page plan and walked her daughter through every line of it. One purchase, one refusal, one flat fee, one boring portfolio, one honest conversation. 18 months in, their paths had already split by more than $250,000, but none of the 5 traps had actually fired yet. Mark learned that on a rainy October evening. His 19-year-old son borrowed the new SUV to drive friends home from practice. Wet road, late break, a motorcyclist with a shattered leg, and a very good attorney. Nobody died, everybody healed. Then the letter arrived asking for $810,000. Mark's auto policy covered $500,000. The judgment didn't care about his policy limits. The gap was $310,000 due to Mark personally. It came straight out of his brokerage account 14 days before Christmas. 14 years of maximum retirement contributions, erased by one rainy evening and one missing document. A $1 million umbrella policy costs about $383 a year, about $1 a day. It sits on top of your auto and home coverage and catches what they can't. One day of legal fees and a catastrophic lawsuit costs more than a decade of premiums. Mark's most expensive purchase wasn't the SUV. It was the policy he never bought. The second trap wore excellent shoes. 1% of $2 million is $20,000 every single year. Your $2 million produces about $80,000 a year of safe income. The advisor takes a quarter of your paycheck, not a quarter of your gains, a quarter of everything the machine produces. And the fee compounds against you because every dollar paid stops growing for you. Over 10 years, a 1% fee on $2 million costs more than $375,000. Over 20 years, the gap versus a low-cost portfolio approaches $900,000. Mark paid $96,000 in fees while trailing the market. Add lost growth, and Trap 2 cost him about $118,000. Carla's flat fee bought her 4 hours and a written plan, $2,500 once. One cost $2,500 once, the other $20,000 yearly forever. Above $1 million, fees are negotiable. Move from 1% to 0.75% and you save $5,000 a year, or $50,000 a decade. The third trap ruins retirements in 36 months. Most people think retirement math is about average return. It isn't. It's about order. 2 retirees can earn identical average returns and end up in completely different universes. It's called sequence of returns risk. A retiree starting in 1995 with $2 million and withdrawing $80,000 a year got strong returns before the crash. By the time stocks fell, the portfolio had already grown. The crash hurt, but it bit into a larger pile. Now picture the same retiree starting in the year 2000. Same $2 million, same withdrawals, same long-term average return, but the crash comes first. Every withdrawal sells shares at the bottom, shares that never get to recover. In one studied case, the portfolio collapsed toward a $600,000 within the early years. 70% gone without one bad decision by the owner. Terrified of a crash, Mark moved $800,000 into cash. The crash never came. The market climbed 31% over the next 2 years. His cash earned almost nothing, while his old shares rallied without him. Missing that recovery cost him about $152,000. The defense isn't all stocks or all cash. It's a buffer. Keep 2 years of spending in cash so you never sell shares into a crash. Trap 4 already had Mark's $150,000. For 11 months, the private fund statement showed exactly what the friend promised, up 40% on paper. Then the fund froze withdrawals. 3 months later, the official letter arrived. Assets impaired, recovery uncertain, 80% loss likely. Mark's $150,000 became $30,000 and stayed there. Lose 50% of your money and you need 100% gain to recover. Lose 80% and you need 400%. Losses and gains are not symmetric. The hole is always deeper than the hill. Most people don't notice they're concentrated because it doesn't feel like gambling. It feels like loyalty. Your company stock, your hometown property, your friend's fund. Familiarity is not due diligence. A friendly face is not an audited balance sheet. The rule that prevents all of it fits in one sentence. No single position gets more than 10% of your net worth. None. Ever. Carla's largest holding when she crossed $2 million was 4%. Boring. Completely. But boring is what staying rich actually looks like up close. The fifth trap never explodes. It just leaks. Lifestyle creep. It started with the SUV, but the SUV was never really the problem. The problem is that every upgrade resets what normal feels like. The new car made the driveway look tired, so the driveway got redone. The driveway made the kitchen look dated. The kitchen made the vacations look small. Within 2 years, the family was spending $128,000 a year. He couldn't name a single purchase that felt extravagant. That's exactly how the ratchet works. The machine produced about $80,000 a year. He was spending $48,000 more than it could sustainably produce. Every $10,000 of permanent annual spending requires $250,000 of capital at a 4% withdrawal rate. That's algebra, not opinion. Mark's extra $48,000 silently demanded $1.2 million he didn't have. Nobody sent him a bill. The bill was his future, shrinking quietly every year. Carla wrote one sentence into her plan. Lifestyle upgrades are capped at 1% of net worth per year total. On $2 million, that's $20,000 a year of guilt-free new spending. The difference between a reward and a ratchet is whether you wrote the limit down first. Then came the final trap. Silence. 70% of wealthy families lose everything by the second generation. Researchers kept finding the same root cause. Not bad investments, not taxes, silence. 64% of wealthy parents have told their children almost nothing about the money. 75% believe their own kids can't handle it responsibly. So the money arrives one day like a stranger, with no instructions and no story. Mark's kids knew nothing. By design, he called it protecting them. The data calls it one of the highest risk strategies there is. Carla took one afternoon and wrote a one-page plan. What exists, where it lives, who to call, and what it's for. Her daughter knows the logic, not just the number. Teach before you transfer. Practice with small amounts before the stakes are real. A will, named beneficiaries, and one honest conversation put you ahead of most millionaires. The strangest part of the story is this. The real reason Mark fell wasn't on the list. Every trap was powered by the exact traits that made him rich. Aggression, confidence, concentration, optimism, trust in his own judgment. Those traits build fortunes, but after $2 million, they can become liabilities. Accumulation is an offense game. You're paid to take risks because you're small. Preservation is a defense game, and defense has a completely different scoreboard. Lose half at 30 and your salary may refill it. Lose half at 51 with $2 million invested and no salary on earth refills it. Your income built the first $200,000. Compounding built the last million. The portfolio now out-earns the person. The game has changed owners. Past $2 million, you are no longer the engine of your wealth. You are its biggest threat. Not the market, not inflation, not taxes. You. Every trap needed Mark's signature to spring. The lawsuit needed his unprotected SUV. The fee needed his handshake. The freeze needed his transfer. The cash bunker needed his panic. The lifestyle needed his yes. Markets take wealth quickly and return it eventually. Owners take wealth slowly and permanently. The same aggression that builds $2 million is exactly the aggression that loses it. Below the line, offense wins. Above the line, the math rewards defense. Defense looks like umbrellas, buffers, caps, audits, and one honest family conversation. Defense is boring on purpose. Boring is the moat. Boring is the whole point. Mark didn't need a better portfolio. He needed a different player at the controls. The moment you cross $2 million, fire the builder, hire the guardian. Same person, new job. Mark's story doesn't end in ruin. Year 3, he ran a full audit of every decision. He bought the umbrella policy that same week. He moved the advisor account to index funds and kept the flat fee checkup instead. He rebuilt the cash into a 2-year buffer, not a bunker, and reinvested the rest. He kept every position at 10% and wrote off the frozen fund as tuition. Then he put a 1-page plan on the kitchen table. His kids learned the number, the logic, and the lawsuit story all in 1 hour. Today, his portfolio sits near $1.4 million and climbing on boring rails. Not where it should be, but the leak is sealed and the machine is running. Carla sits at $2.4 million with a paid-off townhouse and a daughter who can read a fee table. If you're under $2 million, start the habits now while mistakes are still cheap. If you're over it, run the 5-move audit this week. It costs 1 afternoon. The most important financial decision you'll ever make is knowing which game you're playing now. A strategy that's right for someone else can be quietly wrong for you. Do the math, make the decision that matches your reality, not someone else's sales pitch.